Silver has a talent for making smart people do dumb things fast. It starts with a big green candle, a clean, confident surge that looks like a signal, feels like momentum, and whispers the same dangerous sentence into your ear: this time is different. And if you've been around this market long enough, you already know what happens next. Sometimes the very next session, sometimes the very next hour, that green candle turns red. Not a polite pullback, a slap, a reversal that makes you question your read, your timing, and your sanity. That's the whipsaw trap. And the reason it works so well is simple. Silver is one of the best markets on earth at converting attention into fragility, and fragility into forced behavior. The candle doesn't just reflect buying. The candle recruits buying. Then it punishes the recruits. So today we're going to break this down in plain English. Why big green candles in silver are often the beginning of danger, not the end of it. What makes silver uniquely whipsaw-prone. How leverage, liquidity, and clustered orders create overnight red. And the exact behaviors you can watch so you stop getting emotionally ambushed by the same pattern over and over. Quick check-in before we start. Comment one word, trapped or patient, based on how you usually feel after a huge move. Trapped or patient. Then we move. Okay. First, let's define what a whipsaw trap actually is, because people throw the word whipsaw around like it just means the price moved a lot. A whipsaw trap is when a move convinces you it has direction, then reverses with enough speed to force you to act badly. It's not just volatility, it's volatility with timing that targets your psychology. The trap has a structure. Step 1. A big move breaks a level everyone is watching. That attracts attention. Step 2. Attention creates urgency. Urgency creates late entries. Step 3. Late entries cluster their stops in obvious places, usually just below the breakout zone. Step 4. Liquidity thins, because market makers don't want to get run over in a fast tape. Step 5. Price snaps back, hits those clustered stops, and the forced selling turns a pullback into a cascade. Then, because silver is silver, the cascade can overshoot. It can drop farther than reasonable, because in a thin leveraged market, reasonable is not a protective force. It's just a word people say while they get liquidated. Now, why does this happen so often in silver? Because silver lives at the intersection of three things that produce whipsaws. It's smaller than people assume. It's heavily traded through leveraged paper instruments. And it sits in a psychological zone where retail attention can arrive suddenly. Gold can whipsaw too, but silver is higher beta. It reacts harder. It's the wind, not the compass. And when the wind is strong, it doesn't just push you forward. It knocks you over. So let's talk about the engine, leverage. In the paper market, you can control a lot of silver exposure with relatively little capital. That's leverage. Leverage is fun until it isn't. Because leverage doesn't just amplify gains. It amplifies urgency. It amplifies fragility. It amplifies forced decisions. When silver prints a big green candle, leverage traders often pile in because they want the fast move. They want the next leg. They don't want to miss it. That's not a moral failing. That's human wiring. But it creates a fragile stack of positions that all need price to behave politely. And silver doesn't behave politely. When volatility rises, exchanges and brokers protect themselves. Margin requirements can rise, haircuts can widen, spreads can widen. Even if you don't get a formal margin hike, liquidity providers can effectively raise the cost of exposure by widening spreads or pulling depth. That's when the whipsaw gets teeth. Because now if price wobbles, people don't just feel uncomfortable. They get forced. Forced selling is not an opinion, it's a mechanism. And forced selling doesn't care about your thesis. It cares about your collateral. Now let's talk about liquidity, because liquidity is the hidden villain behind red overnight. Most people think markets are deep until they aren't. In calm times, the order book can absorb flows. In stress times, participants step back. Market makers protect themselves. Depth disappears. The market becomes a hallway instead of a room. In a hallway, a small shove moves you a long distance. That's why silver can go from green to red so fast. It's not always someone dumping. Often it's simply the absence of bids when the tape turns. When the bids disappear, price falls until it finds them again. And that search can be violent. Now add one more ingredient, clustered orders. Big green candles usually happen near levels. Breakouts, prior highs, round numbers, obvious zones. Humans love obvious zones because they feel safe. If it breaks this, it's going higher. If it holds that, it's bullish. Those sentences create the same behavior. People enter at similar times and place stops at similar places. That clustering is exactly what makes traps work. If everyone's stop is just below the breakout, then a small reversal can trigger a large forced sell wave. That forced sell wave can push price far enough to trigger the next cluster. Then the next. That's the cascade. This is why the market seems like it targets stops. It's not a cartoon villain. It's physics. Clusters are weak points. Weak points break first. Now why does it happen overnight? Because overnight sessions can have different liquidity than main sessions. Different participants. Different depth. Different sensitivity to headlines. When liquidity is thinner, moves can travel farther before they meet resistance. A reversal that would be a mild pullback during peak hours can become a sharp drop when fewer bids are sitting there. And if you're holding a leveraged position into an overnight session, you're essentially agreeing to play a game where the room might suddenly shrink, and you don't get to vote on that. Now let's bring in the narrative trap, because silver whipsaws are not only mechanical, they're also story-driven. A big green candle creates a story instantly. Something's happening. Squeeze. Shorts are trapped. Supply is tight. This is the breakout. Even when those stories are partly true, the candle amplifies them, and the amplified story brings in more participants. Participants bring leverage. Leverage brings fragility. Fragility brings whipsaws. So the candle is not just a reflection, it's a recruiting poster. And the recruiting poster works best right before the reversal. Now none of this means you should fear green candles forever. Green candles can be real. Breakouts can hold. Silver can trend. The point is that in silver, the path is often designed to punish anyone who confuses excitement with confirmation. So how do you tell whether a big green candle is a healthy move or a whipsaw setup? You watch behavior, not emotion. Signal 1. Follow through. Does silver hold most of the gain into the close and into the next session? Or does it fade quickly? Healthy moves tend to hold. Traps often fade. Signal 2. The quality of pullbacks. In a healthy move, pullbacks are smaller and get bought without panic. In a trap regime, pullbacks are sharp and fast, often with long wicks and ugly closes. Signal 3. The range. Does the daily range expand dramatically after the candle? Expansion suggests fragility. Compression suggests stabilization. Signal 4. The close location. Does the candle close near the high, or does it leave a long upper wick? Long upper wicks can signal rejection and profit taking into strength. Signal 5. The rhythm. Healthy trends have a rhythm. Push, pause, grind, then push. Whipsaw regimes have chaos. Push, dump, snap back, dump again. Signal 6. Liquidity fingerprints. Watch spreads. Watch gaps. Watch sudden air pockets. If the tape feels like it's stepping over empty space, it's a trap-friendly environment. Signal 7. Macro inputs. Silver is sensitive to the dollar and real yields. If the green candle happened while the dollar was firming and yields were rising, you should be cautious about assuming the move has support. If the macro is cooperating, the move has more oxygen. If the macro is fighting, the move is more likely to be a squeeze that can reverse. Now let's talk about the most common psychological mistake that gets people caught. They treat a big green candle as proof. They see it and they think the market has spoken, so they increase size. They add leverage. They chase. They enter late. They move stops farther away because they don't want to get stopped out. That's how the trap wins, because the trap is not designed to beat your analysis. It's designed to beat your discipline. And here's the sentence that matters most in silver. The market doesn't have to beat your thesis, it only has to beat your margin. You can be right about where silver goes eventually and still lose money because you got forced out during the whipsaw. So the adult move is not to fight the market, it's to remove fragility from your plan. Now what does removing fragility look like? It starts with position sizing. If a normal silver swing can ruin your sleep, you're oversized. Reduce it. You instantly become harder to trap. It continues with time horizon clarity. If you're trading short-term, you accept that whipsaws are part of the game, and you define risk tightly. If you're investing long-term, you stop letting intraday candles bully you into emotional decisions. It includes entries. Instead of buying the most exciting candle, you let the candle prove itself. You wait for consolidation. You wait for the market to accept higher prices. You don't have to be first. You have to be unforced. It includes exits. You take partials. You respect that silver gives and takes quickly. You don't need perfection. You need survival. Now let's map a simple scenario tree after a big green candle, because this will keep you calm. Scenario 1. Continuation with acceptance. Price holds above the breakout zone, consolidates, volatility compresses, then resumes higher. That's the healthy path. Scenario 2. Whipsaw trap. Price fades back below the breakout zone, triggers stops, cascades lower, then may even rebound later. That's the trap path. Scenario 3. Chop. Price whips in both directions for several sessions, punishing both longs and shorts until positioning clears. That's the nobody wins except patience path. Your job is not to guess which one happens. Your job is to recognize which one is happening and not be the person who reacts at the worst moment. Now I want to talk about the role of headlines, because headlines often make the whipsaw feel unfair. A green candle forms, and headlines appear that justify it. Then price reverses, and new headlines appear that justify the reversal. The market looks like it's changing its mind, but often the market is just clearing positioning. The headlines are not steering the ship, they're painting the ship after it moves. So if you want to avoid the whipsaw trap, stop letting headlines set your emotional state. Let behavior set it. Behavior is holds, closes, ranges, follow through, liquidity. That's the truth layer. Now one more detail that makes silver traps nastier than people expect. The split between paper price and physical experience. Physical holders care about premiums, availability, and delivery. In stress periods, physical can stay tight even if paper whips. So a paper dump doesn't always mean physical becomes cheap. That disconnect frustrates people and can create more narrative noise, which can pull more speculators in, which can feed more volatility. Again, attention feeds fragility. Now let's bring it home with the core lesson. Big green candles are not your enemy. Fragility is. The market punishes fragility. It harvests urgency. It uses obvious levels and clustered stops to create cascades. It exploits thin overnight liquidity to exaggerate reversals. And it rewards the person who is not forced to act today. So the next time silver prints a monster green candle, ask yourself a simple question before you do anything. Is the market offering you stability, or is it offering you excitement? Stability gives you time. Excitement demands urgency. Urgency is where traps are stocked. One question for you, and I'm keeping it to one. When you see a huge green candle in silver, do you usually chase it or wait for the pullback? Comment chase or wait. If you got value out of this, subscribe. I'll keep breaking down silver in plain English without the hype, because silver doesn't punish people for being dumb. It punishes people for being forced. Educational only, not financial advice. I don't know your situation, and nothing here is a recommendation to buy or sell anything. Manage your risk, make your own decisions, and stay unforced. Now let's get even more specific about why big green is such a reliable trap trigger in silver. It's because green candles change two things simultaneously: perceived probability and perceived urgency. Perceived probability is the feeling that the breakout is confirmed. Perceived urgency is the fear that if I don't buy now, I'll miss it. Those two feelings together create the perfect cocktail for bad entries. And bad entries are what make stop clusters. Stop clusters are what make cascades. Cascades are what make overnight red. Let's talk about obvious levels, because this is where the trap becomes almost mechanical. When silver clears a prior high, a round number, or a widely watched zone, it isn't just breaking a line, it's breaking a shared belief. Thousands of participants who were waiting for permission suddenly feel like they got it. Their entries bunch up. Their stops bunch up. Their take profits bunch up. And liquidity providers, seeing the crowd form, often widen their stance because they don't want to be the last one holding risk when the tape accelerates. The irony is brutal. The more obvious the breakout, the more likely it is to be tested. Not because the market is evil, but because the market is a discovery process. It tests new prices to see if the demand is real or merely excited. That's why the best breakouts often don't feel exciting. They feel boring. They grind. They build. They make you doubt them. Then they go. Trap breakouts feel like fireworks. Fireworks look amazing, and then they disappear. So here's a practical shift you can make today. Stop judging a candle by its color, and start judging it by acceptance. Acceptance means the market holds a new area and begins using it as a floor. You'll see multiple closes above the zone. You'll see pullbacks that get bought without drama. You'll see volatility start to calm. It won't be perfect, but it will be constructive. Rejection means the market touches the new area and then spends time below it. You'll see closes back under the breakout. You'll see long upper wicks. You'll see high excitement, low follow-through. That's the trap signature. I know what some of you are thinking. If I wait for acceptance, I'll miss the move. Sometimes you will, and that's fine. Missing a move is not a moral failure. Getting trapped in a whipsaw is often a financial one. In silver, the cost of being early is often higher than the cost of being late. Early participants can survive because they have cushion. Late participants have no cushion. Cushion is what keeps you from being forced. So if you want a simple rule, buy when you can survive being wrong for a while. Avoid buying when you'd be instantly punished for being wrong. Now let's talk about overnight specifically, because the title promises it. Overnight red happens because the market's risk tolerance changes when fewer participants are present. The order book can be thinner, spreads can be wider, and a single flow can move price farther. A reversal that would be a mild pullback during peak hours can become a sharp drop when fewer bids are sitting there. And there's a psychological angle too. Overnight moves feel more threatening because you weren't there to experience them, so your brain fills the gap with fear. So here's a defensive habit. Before you hold a silver position overnight, ask yourself, am I okay with waking up to a move I didn't witness? If the answer is no, your size is too big for overnight risk. Now what do you do if you think you're already in the trap? Be honest about the tape. Ask, is price holding above the breakout area? Are closes staying strong? Is the pullback orderly? Or is it slicing through levels quickly, with expanding range and weakening closes? If it's the latter, you're in a fragility environment. That doesn't mean you must instantly exit. It means you must stop pretending this is a calm trend. In fragility environments, the best move is usually to reduce fragility. Cut size, tighten risk, stop adding, and stop bargaining with the chart. Rationalizing is how traps become disasters. One more piece that makes the trap feel brutal is how quickly control can change hands. A green candle often begins with eager buying, but the moment volatility spikes, risk controls wake up. Margin gets tighter, spreads widen, And some participants are forced to de-risk even if their thesis hasn't changed. That forced de-risking becomes supply at the worst time. Then you get the second punch. Once the first wave of stops triggers, it creates a vacuum where bids pull back, price drops faster, and the move feeds itself. That's why the reversal often feels like it came from nowhere. It didn't. It came from the structure, crowded entries, obvious stops, thin liquidity, and risk controls that turn hesitation into action. The market simply followed the path of least resistance, fast. Now build a simple whipsaw checklist you can run whenever silver prints a big green candle. First, did the move happen into a widely watched level? If yes, trap risk increases. Second, did the candle close near the high or leave a long upper wick? Long wick increases trap risk. Third, did the daily range expand dramatically compared to recent days? Expansion increases trap risk. Fourth, did the next session hold above the breakout zone or immediately slip back under? Slipping back under increases trap risk. Fifth, do spreads feel wider and does the tape feel jumpier? Wider spreads increase trap risk. Sixth, is the move supported by calm behavior in gold, or is silver acting alone like a hype event? Silver acting alone increases trap risk. Seventh, are you feeling urgent? Your urgency is a signal that the trap is recruiting you. You don't need to hit every item. The point is to stop making decisions based on one candle and start making decisions based on a cluster. Now here's the clean lesson. Big green candles are not proof. They're invitations. Sometimes they invite you into a trend. Often they invite you into a trap. The difference is whether the market gives you time. Healthy moves give you time. Traps demand urgency. So the next time silver goes vertical and your brain screams buy, pause and ask one question. Am I about to buy stability, or am I about to buy excitement? Because excitement is what turns green into red overnight. Stay patient. Stay unforced. Let the market earn your participation.